Good afternoon to those in the room and online. I welcome you here at the Urban Institute in Washington, D.C. My name is Todd Hill-Jones, and I am the Policy Program Manager with the Urban Institute's Housing Finance Policy Center. Today is November 12th, the day after Veterans Day, which, as you know, is a federal holiday that honors persons who have served in the United States Armed Forces. If anyone in the audience is a military veteran or through family supports a veteran, can you please stand and be recognized? Please join me in recognizing these folks. For those who have served and to the military family members who support them, we thank you all for your service and sacrifice to our nation. We are very pleased to have you all here today for our data talk to discuss how the United States military has helped level homeownership and wealth-building opportunities between whites and people of color, and how Veterans Affairs mortgages are an important contributing factor to this equalizer. I want to encourage everyone in our audience, here and virtually, to continue our dialogue by sharing your thoughts and observations on social media using the hashtag #LiveAtUrban. You can tweet at me and other speakers throughout the program using the speaker Twitter handles displayed on your program agenda. As many of you know, the Urban Institute strongly believes that data, facts, and evidence matter. They help us to understand complex economic and social problems at the local, state, and national level. Our goal is to use evidence to elevate the debate. In the Housing Finance Policy Center, we provide timely, impartial data and analysis to show how the housing finance system impacts households, communities, and the broader economy, as well as contribute to efficient markets and economic opportunity. I want to take a moment and recognize and thank today's presenters. I'll provide a brief introduction now and frame our program agenda for all of you. I will note that the full bios of today's presenters are part of your materials. First to present will be Lauren Lamble Hansen. Lauren is a principal financial economist at the Federal Reserve Bank of Philadelphia in the Supervision, Regulation, and Credit Department, where she coordinates the Philadelphia Fed's Supervisory Research Forum. Lauren will present her research on institutions and the geographic concentration in VA mortgage lending. Next, we'll hear from my colleagues, Jung-Win Choi, a research associate with the Housing Finance Policy Center, and Sarah Strochak, a research analyst with the Housing Finance Policy Center. My colleagues will present some of our center's findings from a yet-to-be-published report on the impact military service has on equalizing racial homeownership and income gaps in some areas of the country. Finally, we'll conclude by hearing from Patrick Lapid, an economist in the Office of Research at the Consumer Financial Protection Bureau. Patrick will present research from a recent CFPB report on mortgages to first-time home buying service members, and will also comment on the findings of the two other presentations by Lauren, Jung, and Sarah. When Patrick concludes, I will moderate a brief discussion with our presenters, and I'll invite questions from our in-person and online audience to join in the dialogue. For our virtual audience watching over the webcast, you can submit your questions to events@urban.org anytime during the program, and our staff will filter those questions to me. So without further ado, I invite Lauren to kick off our presentations, and again, I thank you all for being with us here today.
Hi, thank you for inviting me to present this research today. This paper is co-authored with Carrie Spitzer of Bay State Health. While I work at the Federal Reserve, of course, the standard disclaimer applies that these are our views and not those of the Philadelphia Fed or the Federal Reserve System. Carrie and I began looking at data on VA mortgages years ago while we were PhD students, and we were curious why some places with so many veterans and active duty service members had so few VA loan originations, and why other areas had so many more VA loans than what we would have expected based solely on population demographics. We quickly learned that many people eligible for the program either don't realize that they exist, that the program exists, or don't realize that they qualify for it. Carrie was doing a lot of her research on veteran populations, including interviewing veterans and service providers, and we started to wonder if the institutions that serve veterans enable knowledge transfer about the VA program. This project is meant to explore the data to get a sense for what the role these types of institutions may play. The VA program was created in 1944 as part of the GI Bill. The way that it works currently is that loans are originated by private lenders and they're guaranteed by the VA. The VA insures the first 25% of the loan amount, but there is a dollar amount cap. Currently, loans at or below the FHFA county conforming loan limit can be fully insured with receive the full 25% insurance with zero down payment from the borrower. VA borrowers do not have to make a monthly mortgage insurance payment, but most borrowers do incur an upfront VA funding fee, which can be paid by the borrower at closing, rolled into the mortgage, or it can actually be paid by the seller of the home. The amount of the funding fee is a function of the size of the down payment, whether the borrower is taking cash out, the borrower's type of military service, whether this is the borrower's first or a subsequent VA loan, and other factors. Fees commonly range from 1.25 to 3.3% of the loan amount, although they can be waived for certain veterans with service-related disabilities. Despite the fee, the loans tend to be more affordable than other low down payment alternatives. Veterans, active duty service members, some members of the National Guard and Reserve, and some surviving spouses may qualify. You don't have to be a first-time home buyer to use the program, and you can reuse the benefit. According to a 2010 National Survey of Veterans, 66% of veterans who have ever owned a home have used the VA loan program. Half who used it indicated that they did so because of the no down payment option. Of those who owned a home but did not use the program, 1/3 responded that they just didn't know about the program. It seems plausible that proximity to Veterans Service Organization posts, VA facilities, and military sites may increase the use of the program by raising awareness. There have been several different strands of research on the VA program. For example, there's been debate on whether it contributed to suburbanization. It's been shown to have increased homeownership rates by decreasing the age of first home purchase. But in easing credit access, it's been found to have pushed up house prices historically. The most recent published work on the VA program finds that it's helped integrate neighborhoods. We focus on VA purchase mortgages, primarily because they more directly affect homeownership outcomes, but also because refinance volumes are driven so much by interest rate changes. This chart shows Home Mortgage Disclosure Act data on the volume of VA purchase loans between 1990 and 2017, the orange bars, and the percentage of all mortgages that were VA and the dotted lines. You can see that VA lending was on the decline leading up to the crisis. This makes sense as alternative low down payment options were widely available in the market during this time. But after 2007, when the low or no down payment loans once sold into private label mortgage-backed securities essentially disappeared, VA lending volume surged. 2017 was the best year for VA purchase loans between 1990 and 2017. But as you can see, they still made up less than 10% of loans. This chart shows that the FHA loans shown in red here surged during the same time period when conventional loans shown in blue were declining rapidly. Interestingly, FHA purchase mortgages peaked in 2009, whereas VA have continued to steadily grow. Lori here at Urban has done a lot of work on the impact of the False Claims Act on depressing FHA lending, which might be part of why FHA and VA have diverged. In fiscal year 2017, about half of the loans that were originated through the VA program were used for home purchase or new construction. 41% of those were made to first-time home buyers, and 80% of purchase loan borrowers put no money down. Although we focus only on purchase loans in our research, there's a thriving business in VA refinance. Borrowers can refinance to lower their interest rate or to take cash out. Not surprisingly, VA mortgages as a percentage of all loans are not distributed evenly across space. There are larger concentrations in the Southeast, Texas and New Mexico, and certain places in the Great Plains states. But we'd expect this to be driven in large part by the uneven distribution of where veterans and active duty service members live. So when we instead think about the rate of VA lending per eligible resident, we also see concentrations in these areas and others, like right along the East Coast and the Texas and Mexico border, as well as in Alaska. For eligible residents, we're using a proxy for likely eligible borrowers who are of a home buying age. Specifically, we're looking at veterans and active duty service members who are under the age of 65, according to census data for these counties. This chart ranks each county by the fraction of its adult population that's eligible, and the percentage of loans that are VA for the year 2017. So counties are displayed according to their percentile on these two dimensions. You'd expect that counties would mostly pile up along the 45-degree line, right? More eligible borrowers, more VA loans. And certainly there is a strong correlation, but you also get notable outliers. If you look in the lower right quadrant of the chart, what you can see is that there are a lot of counties where there are many eligible borrowers, but relatively limited use of the VA program. In 2017, nearly all of these counties are in the top 25% of home prices, shown by the blue circles, and they're in large MSAs in the Northeast and in California. Veterans may be less likely to buy with VA loans in these places, given the loan guarantee limits of the program relative to the rising costs of buying a home in these places, or the relative purchasing power of veterans may be lower in these places. We also do see some places that break from this overall point cloud in the top left quadrant, indicating more VA use than what we'd expect based solely on the eligible population. Interestingly, some of those are in high-cost areas too. Here we show the same chart, but instead of for just 2017, we're showing a separate chart per year going back to 2006 in the top left corner. And what you can see is that since the onset of the financial crisis, there's been less dispersion in use of the VA program, right? There's more pileup along that 45-degree line. And presumably this is driven in part by many of the previous low down payment options becoming scarcer. So we especially see a lot of movement out of that lower right quadrant up to the 45-degree line. To look into this closer, we combined HMDA data at the county level with additional information from census, such as owner occupancy rates and the relative median incomes of veterans to non-veterans. And we collected information about the location of major veteran service organization posts. We selected the four major organizations in the US, the American Legion, the Veterans of Foreign Wars, the Military Officers Association of America, and AMVETS. We get information on military installations, bases, and ranges from the Department of Defense, as well as the location of VA facilities, including hospitals, clinics, veteran centers, and cemeteries. And I'll explain in a minute why we care about cemeteries. From Zillow, we collect county-level house price indices and median home values. So what we end up with is a panel data set of counties from 2006 through 2017. For our regression analysis, we restrict to counties that have the one-year American Community Survey data available and Zillow house price data. And this amounts to a total of 657 counties that we can follow over this entire time period. Certainly, this is not a random sample of all counties in the US. Particularly because of the ACS data restriction, this is going to focus on more populous counties. Here's some maps of these key types of institutions. In the top right corner, the red dots are showing major military bases. In the lower right corner, you'll see the VSO posts. And this composite map in the lower left shows veteran centers, hospitals, clinics, and cemeteries. And you can see that these are by no means distributed evenly, either by population density or across space. So to look at the correlation between VA use in these institutions, we estimate two sets of models at the county by year level. In the first set, the dependent variable is the percentage of total originations that are VA mortgages. In the second set of models, we use the rate of originations, so the VA mortgages per 10,000 eligible residents age 18 to 64. For controls, we have the year, the percentage of the population that's eligible, the distance from the county center to the nearest military base, and the nearest of each of the type of the VA's facilities, density of VSO, these social organization posts in the county, Zillow home value, and house price growth, owner occupancy rate, and ratio of median income for veterans to non-veterans. We also include state fixed effects. Thinking back to those scatter plots that I showed you and how over time some counties have converged to that 45-degree line, we assume that there may be some county-specific factors that have led to more VA loan growth in some places than in others. Factors that aren't accounted for in this list of controls. So we employ a mixed effects multi-level modeling framework to specify the error term of the model such that each county can have its own growth trajectory during the sample period. Here's what we find with the first set of models, where the dependent variable is the percentage of all purchase mortgages that are VA. Not surprisingly, VA loans make up a larger share of originations in places where there's a greater percentage of the population that's eligible, and where veteran median income is higher relative to non-veteran income, so more purchasing power by veterans. VA loans make up a smaller share of originations the farther a county is from a military base and where county home values are greater. We don't see any evidence that proximity to VA facilities or VA social organizations is positively correlated with VA mortgage use. So here's where the cemeteries come in. We use those as a means of falsification, basically, in our models. If we were to find that there was a correlation between being close to a VA cemetery and having more VA lending, we would conclude that what we were not doing is adequately capturing the historic presence of veterans in a community. Fortunately, we don't find any correlation between VA cemeteries and use of the VA loan program. So we were also interested as another sort of form of falsification on this military base result. We were interested in whether there's just like a larger demand for low down payment mortgages near military bases. So in the third column on this table, we estimate a version of the model where we swap in a new dependent variable. We use the percentage of loans that are FHA rather than VA. And we find that this military base distance result goes away. So proximity to a military base does not affect FHA lending. This chart helps us think about the magnitude of these effects. Counties with a military base on the left, the red line, have a 3.7 percentage point larger share of VA loans on average than counties that are the median distance from an installation, which is 20 miles away. This is economically significant, 3.7 percentage points, considering that the county median VA share ranged from 1.8 to 9.4% during our sample period. On the right, we look at house prices. As house prices increase, the percentage of VA loans decreases. Moving from a county with the median Zillow value, $150,000, to a county with a home value of about $215,000, which is the 75th percentile in the data set, is associated with a 2.1 percentage point decrease in the share of VA loans. Okay, so our second set of models looks at the number of VA loans per eligible resident. This is a tricky dependent variable because if you think about it, it's also just kind of measuring the overall health of the county's economy. Just there are more loans. It might not specifically be that there are more VA loans, but there's just more lending, perhaps. And indeed, what we see is that this measure is positively related to area home values and HPI growth, but it's negatively related to distance to the base, which is consistent with the first set of models. So the closer you are to a military base, the more VA lending, both in terms of a percentage of overall purchase mortgages, but also in terms of the rate of loans that are made per eligible resident. Again, we see no evidence that FHA mortgages are associated with proximity to bases, and we see no evidence of greater proximity to VA facilities predicting VA loan use in the way that you might expect, that being close to those institutions leads you to have more VA loans. In fact, if anything, that's the opposite, which we can discuss later in the Q&A if you're interested. In terms of magnitude, moving from a county with a military base, the red line on the left chart, to a county the median distance away, the black line, 20 miles away from a base, is associated with a 70 loan decrease in the number of originations per 10,000 eligible. This is, again, a substantive effect since over our sample period, the median number of VA loans per 10,000 eligible in a county is 143. Also, an increase in the home value from the median to the 75th percentile is associated with a 44 loan increase in the number of VA loans used. Okay. We recognize that our measure of distance to a base, which is distance from the county centroid to the base, is not ideal, right? Especially for very large counties. So we re-estimate our models, removing counties with very large land area, and we find that our results are highly robust to excluding those. An important question is, what are we observing here? Why are we observing this correlation? And one common thing we think about, and others have discussed with us, is maybe lenders are really different, the lenders that serve areas near bases. So when we looked into that, though, we didn't find a lot of evidence that that's the case. We found that the top 7 VA lenders in counties with bases are the exact same top 7 that serve counties without bases. In terms of those 7's market share, in counties with bases, those 7 make up 33% of loans. In counties without bases, they make up 31% of the VA loans. These are large national lenders. Neither types of county have any evidence of concentrated VA lending based on a Herfindahl-Hirschman index, which is also pretty interesting to us. We definitely need more analysis on how the program's guarantee limits affect how people use the program. Unlike with conventional loans, you can go above the VA limit. It's just that you're going to have to put some money down, right? Because the structure of the guarantee changes. In 2017, only 3% of VA loans originated nationally excluded the 0 down payment loan limit. And this was higher in high-cost counties, but still it was only 6% of loans that exceeded the limit. So it's hard to know how binding these loan limits are for borrowers and how that could affect uptake of the program. To conclude, in recent years, the VA home loan program has grown both as a share of all mortgage originations and in the total volume of originations. Many eligible borrowers may still be unaware that they qualify for the benefit, though. Use of the program has been strongest in areas near military bases, even after accounting for the fraction of the population that's eligible. So why is this? Are lenders, real estate brokers, or home sellers around military installations more willing to engage in the process of financing a home purchase with a VA loan? There's certainly some public perception that VA mortgages have a more onerous closing process than other types of loans, so it might make sense to us that in areas where the program is more heavily used, even with the same lenders, there may be more warmth toward using it and less discouragement. Finally, another important question moving forward is whether VA loans are going to keep their popularity as alternatives in terms of other low down payment loans become available. So thank you, and if you're interested in the paper, you can find it on the Harvard Joint Center's website.
Hi, everyone. Thank you for joining us today. Again, my name is Sarah Strochak. I'm a research analyst here at HFPC. So for the past several years, HFPC here at Urban has been documenting the growing racial homeownership gap. The black-white homeownership gap was at 30 points in 2017, which is wider than when the Fair Housing Act was passed over 50 years ago. In 2018, we looked at the gap across major US cities, and we found that not a single city with a sizable Black population had closed the homeownership gap, but that many of the cities with the smallest gap were located near large military bases. And a few weeks ago, we released another paper that attempted to explain this gap. And what we found was that even when we control for differences in demographics, income, and credit, this gap persists, and a large part of the gap still remains unexplained. So all of this prior work has pointed us to the research that we're presenting today, which explores how the US military may act as an equalizer for income and homeownership opportunities. So first, a little background on the demographics of the veteran and the active military populations. In 2017, there were 18.2 million veterans, which makes up a little over 7% of the population. And there are approximately 1.3 million people serving in the active military. So on the left here, we break down the racial composition of veterans, active service members, and the total population. The blue section of the bars on the left represents the non-Hispanic white population, And so you can see from this chart that the veteran population is disproportionately white, while the active military population looks a lot more like the general population in terms of the racial composition. The figure on the right breaks down the populations by age. So you can see that veterans are relatively older than the general population. And here, the blue bars represent the share of the veteran population, the yellow, the active military, and the black bars, the total population. So 68% of veterans are over the age of 55, compared with just 37% of the total population. And the active service shows the opposite trend. So 72% of those currently serving in the military are under the age of 35, compared to just 30% of the total population. So next, we're going to take a look at educational attainment. So here, the blue bars represent those that did not complete high school, and the yellow bars represent those with a high school degree, black the share with some college, and gray the share with a college degree. So we see that close to 80% of active service members have at least some level of college education, which is much higher than the US population, closer to 55%. And veterans have a higher share of those with a high school degree than the general population, but a lower share that did not complete high school. And that's likely because a high school degree is generally required for military service. And we also see that a lower share of veterans have a college degree, which is in part due to the fact that the veteran population is significantly older than the general population. So now we can start taking a look at homeownership rates for these different groups. So this analysis is at the household level, and we define a veteran or an active service household as a household where any member of the household is a veteran or is in the active military. So it's not just if they're the head of the household, it's if the household contains a veteran at all, they're considered a veteran household. And that applies to this slide and all the slides that will follow. So veterans have a significantly higher homeownership rate than the general population, 78.2% compared to just 64% for the total population. Active duty members have the lowest homeownership rate at 42.7%, and non-military members have a 61.8% homeownership rate. So that means we're seeing a 16.4% gap between veterans and those who did not serve in the military. And active service members have the lowest homeownership rate, but that's likely due to the fact that they're younger, they're more mobile, and they may have housing provided to them for their service. So some of this difference is to be expected because we've just seen and we know that veterans are older, whiter, disproportionately male, and higher educated than the general public. And these are all qualities that make you more likely to be a homeowner, and we've documented that in our prior research as well. But even when we start to break down the homeownership rate by demographics, these differences persist. So in this chart, the blue bars, again, they represent veteran households. The yellow bar is active service households, and the black bar, all households. So we can see that veterans have a higher homeownership rate than the total population at all three age groups that we looked at. And so while the homeownership rate for active service members is the lowest in the youngest age group, so that's that yellow bar that's 28%, it's the highest in the oldest age group. So active service members over 55 have a homeownership rate of 87%, which is higher than veterans at 84%, and the general public at 77%. So next, we're going to break down the homeownership rate by race, and this is when we can start to see that the racial gaps in homeownership are smaller for veterans and active service members than for the general population. So we're first going to focus on these first two sets of bars in this chart. So the first set is the homeownership rate for non-Hispanic white households, and the second set is the homeownership rate for black households, also broken down by military status. So like I mentioned at the beginning of the presentation, the overall homeownership gap is 30 points, and you can see that between this first black bar, which is 72% homeownership rate for white households, all the total population, and the second black bar, which is the 42% homeownership rate for black households. So that's where we're getting that 30% gap. And so then once we start to narrow this down to just veteran households, we see that gap shrink. So looking at the first blue column, we see an 82% homeownership rate for non-Hispanic white veteran households versus a 63% homeownership rate for black veteran households. And so we're seeing that gap shrink to 19 points. And for active service members, the gap shrinks even further to 11 points, so 46% for white households and 35% for black households. And this holds true for Hispanic, Asian, and households of another race, although to a smaller degree. But we know that there are confounding demographic factors that may be influencing this as well, such as the fact that the white population tends to be older, which also makes you more apt to be a homeowner. So these three charts break down the homeownership rate by race, age, and veteran status. So on the left, we're looking at households with the head under 35, in the middle between 35 and 54, and on the right above 55. And so what we see from these charts is that for every single age and race group, veterans still have a higher homeownership rate. So comparing the blue lines, the blue bars to the black bars for every single racial group and age group, we're seeing that veterans have a higher homeownership rate and active service members have a higher homeownership rate once they reach a certain age. And now I'm gonna hand it over to Jung. She's gonna present our regression results. Whoops, sorry, I have one more slide. We ran these same tables for household income, and we saw really similar results. So for the general population, the median household income for white households was $65,000 in 2017, and for Black households, it was only $40,000, which means we're seeing a $25,000 difference here. When we look at just veterans, we see that gap shrink significantly. So Black veteran households had a median household income of $59,000, which is much higher than the median household income for all Black households, $40,000. And the income gap between Black and white veteran households is much smaller at only $7,100. The income gap between active service Black and white households is also lower at $16,000. And now I'm going to hand it over to Jen.
Okay. So now we're going to move on to the regression analysis, which tests whether the veteran status and the presence of the military base affects home ownership and household income. So this table shows the summary statistics, and we use the ACS 2017 data. So as Sarah mentioned, we do see differences in home ownership and household income across veteran status, as well as differences in age and education. And I also want to mention that, as Sarah mentioned, veteran households, the head of the veteran households are significantly more likely to be male. About 70% of veteran households are headed by male. And also they are significantly more likely to be married. So the household who are married is about 67% for veterans and about 74% for active duty member, which is about 20 to 25 percentage point higher than the non-veteran household. And as you can expect, veteran households are significantly more likely to, sorry, I thought I would have a screen here, but then I just saw it just now. So veteran households are significantly more likely to, I thought Lauren and Sarah was looking at a computer here, and then I kind of, but then, okay, so if you see the PUMA level data, you will see that veteran households are significantly more likely to live in a PUMA where it contains a military base. And PUMA, by definition, is an area defined by a census which contains about 100,000 population. So you can see that about 50% of people who are active in military are living in a PUMA with a military base, compared to 14% of veterans and only 9% of non-veteran population. And you can also see that for veterans, for active duty members, they are living in PUMAs where it's closer to the military base. And in all our regression analysis, we also control for home prices, as Lauren did, to control for affordability. Okay, so here is a regression analysis. The number is really small for some reason, so I'll try to explain them, and I'll try to kind of like point out the numbers in our slides. Okay, so on the left side is our regression model. So we control for everything that you have just seen in the summary statistics. And what this is showing is that compared to non-veterans, how are veterans homeownership, how much is veterans homeownership higher? So this blue bar is suggesting that controlling for everything else, veteran homeownership, the likelihood of veterans owning a home is about 1.2% higher than non-veterans. And for active members, which is in the red line, red bar shows that active duty members have about 11.2% lower homeownership rate than non-veterans after controlling for everything else. And if you do remember what Sarah presented, we actually saw that the homeownership rate difference between veterans and non-veterans was about 16 percentage points, and the homeownership rate difference between active duty members and non-veterans were about 20 percentage points. So we see that after we include for all other factors, the difference in the homeownership gap between the population actually becomes smaller. But it's still there and it's still statistically significant. And to the right side, what we see is that we kind of see whether veteran status and homeownership relationship differs across race and ethnicity. So as Lauren mentioned, veterans have access to VA mortgage, which provides no down payment options. And as we know that the people of color, on average, have significantly less wealth. So this option could be it could be more valuable for people with considerably lower wealth. So that could have a more positive impact for the people of color. And in the table on the figure on the right side does show that, and I will provide you some numbers because I think it's difficult to see in these figures. And what this is showing is that for white population, it actually shows that the veterans have slightly lower likelihood of owning a home than non-veterans after controlling for everything else. But the difference is only 1 percentage point. For Blacks, Hispanics, and Asian population, we see that the likelihood of owning a home is significantly higher for veterans compared to non-veterans. For example, for Hispanics, there's an 11.4 percentage gap, and for Black veterans, there's 8.23 percentage gap between veterans and non-veterans. This again suggests that this low down payment option could be especially more valuable for people with really a small amount of wealth. Okay, so next we kind of look at whether the veteran status affects household income, and the answer is yes. So you can see that for veterans, even after we control for everything else, they have higher household income than non-veterans, and also active duty members have higher household income than non-veterans. So the number here shows that veterans, once we control for everything else, have about 16% higher household income than non-veterans. And for active duty members, we see that the household income is about 8% higher. And again, in the bars to the right side, we see that there exists racial and ethnic disparities. So it shows that the income for Blacks, Hispanic, Asian increases more with the veteran status compared to white. For whites, we see that if you're a veteran, your household income is about 12% higher than the non-veterans after controlling for the socioeconomic status, such as age, race, age, education, and sex, and also home price. I think we control for home prices, and we also control for state fixed effects in the regression. But for Blacks, we actually see that if we control for all those factors, Blacks' household incomes for veterans is about 36.5% higher. So these two results, the results that I showed previously and now, they're both showing that veteran status actually kind of like equalizes the racial and household income gap. So next set of regression, we wanted to look at whether the presence of a military base affects homeownership and household income. So this is where military bases with more than 400 employees as of 2009 are located. And you can see from this map that the military bases are largely concentrated in the southern part of the country, as presented by Lauren. So the first set of regression, we first wanted to look at the relationship between military base and home ownership. And why would the presence of a military base affect home ownership? So as Laura mentioned, one of the factors is due to the information. If you're near a military base, you can probably have greater information about the VA loans. And we also think that veteran military base can play as an employment anchor in the area. So if you're near to the base, there could be a greater employment opportunity for a stable job. And this could be more important for people of color who on average have lower job security in this country. So what we see in this regression is that we do see that if you are a resident of Puma, where there is a military base, your likelihood of owning a home increases about 0.9 percentage points. So this is not a big number, but what we see is that there again is a difference across race and ethnic groups. So we see that the Black in yellow bar and Hispanic in the green bar, we see that their home likelihood of owning goes up more compared to the whites and Asian if they live in a Puma with a military base. And I would also like to point in this slide that the size of the coefficient is smaller than the veteran status itself. And here in the regression, we also control for the veteran status. So what this is saying that even if we control for the veteran status, if you live in a Puma with a military base, your likelihood of owning goes up, but it doesn't go up as much as the veteran status itself. So VA status probably is more important in homeownership than the presence of VA, the military base, but the military base still matters. Okay, so in our final regression, we also looked at the relationship between the military base and household income. Here in this analysis, we don't really see any relationship between household income and the presence of military base for the total population. So there is no statistically significant relationship. But if we look across race and ethnic groups, we do see there again is differences across race and ethnic groups. And we see that Black, Hispanic, Asian household income are likely to increase more in a Puma where there's a military base, but we actually see a negative relationship for the white population. Again, I want to point out that here, although you can't see the size of the coefficient, you have to trust me. And if you're interested, this report will be out really shortly for you to have a closer look. But then we actually see a smaller size of a coefficient for the household income and military-based relationship compared to the veteran status and household income relationship. So to conclude, this is my final slide. So as Sarah and I presented and showed in a couple of our slides, a military base and also military itself is a great equalizer to decreasing the gap in homeownership and household income between the people of color and non-Hispanic whites. And we also find in the regression that the presence of a military base in the area does contribute, although the size of the magnitude of the contribution is smaller than the veterans status itself in decreasing the homeownership gap and household income across race and ethnic groups. So thank you.
Oh, thank you very much. Okay. So good afternoon. Thank you, Urban Institute, for inviting me here to be discussing on these two great papers. And thank you to Lauren, Jung, and Sarah for your presentations. As always, again, my name is Patrick Lapid. I'm an economist in the Office of Research at the Consumer Financial Protection Bureau. And as always, the normal disclaimer applies. Any of my views expressed today are those of myself and do not necessarily reflect those of the Consumer Financial Protection Bureau or the United States. So it's all mine alone, all right? And I do apologize if I may go into some sample size of one experiences of getting a VA loan, and so please apologize for those as they may come up. So biggest takeaway today that we get from both papers is that military base locations do matter for VA loan use. And both papers both approach this in slightly different ways. Spitzer and Lamble Hansen's, the big other takeaways related to this include that base proximity matters even when you control for veteran populations, so that even in areas that have higher or lower shares of veterans or populations of veterans, that the proximity is still relevant in both cases. We also see that the location of VA facilities and VSOs, Veterans Service Organizations, don't affect loan use, which was interesting finding to me, and I have some thoughts about that as we go on. In addition, they have found that both in relative and absolute terms that VA loans increase. The relative measure of the share of VA out of all home loans increases with base location, as well as the rate of VA loan use per 10,000 eligible adults, which you can translate to be an absolute measure. The last main point that we got from their paper was that although VA loans increased, we didn't see a change in VA FHA loans, which may be an indicator of overall mortgage activity rising. Although we don't see conventional loans, I mean, FHA is a good indicator of first-time home buyers, but we don't see a change in overall loan use among that group from their paper. Lastly, I didn't have room to fit in on these slides, but I do also like the 2006 to present scatter plots showing how the relative the changes of high cost versus low cost areas. It was pretty clear in 2006 how high cost areas were underrepresented in the VA program and how that's changed over time. Although we do see that there are some high cost areas, including where I'm originally from, the San Francisco Bay Area, that actually underperform in terms of VA use. But you know, we can discuss possible sources of that in later on. In our second paper today, they look more at differences both by veteran active duty status, as well as whites and people of color. And we do see that both, that primarily for people of color, the effect of veteran or active duty status does associate with increased home ownership and household income, which is not necessarily the case for white veterans. So when you combine all of these groups together, there is a small increase in home ownership, small increase in household income. But for white veterans, it's basically the same comparing them to non-veterans in terms of what happens to home ownership and household income later on. In what they are able to do with the base presence is also combine that with different types of homeowners, active duty, veteran, non-veteran, and people of color versus whites. And they find that that base presence is also clustered among people of color, even when you include controls for veteran or active duty military status. Lastly, it's important to see the descriptives up front, and they do a great job in putting up front that when we talk about veterans, we really have to take into account age, that active duty are younger than the general population. Veterans, excluding ones that served most recently in Iraq and Afghanistan, when you're talking about a veteran, your modal veteran right now is someone that served in Vietnam. So someone that's over 55 and maybe, in this case, user of programs such as VA disability, VA medical care, compared to the VA homeownership program, which generally we would generally think it would, as a first-time home ownership program, looking at those under, say, age 40. So I guess the big thing in the background is what's the mechanism, what's going on here, and then some other comments and questions I'll add in. For the most part, from my understanding, as Lauren has told me, that their paper is forthcoming. So I'll keep their comments are more general. Hopefully, future researchers can pick these up and move forward with it. This big question of why don't VA facilities and VSOs matter for VA lending? As I mentioned just right now, the relevant population for these institutions may be older and retired veterans that already may already have a home and so on. That these facilities generally are, a lot of these facilities and VSOs, except for a few new ones, generally serve an older population. But as I said before, this may be more relevant for use of other VA programs and knowledge, information, the spread of information about using health or using disability benefits, which are their own also difficult to navigate in some ways. And going further on, why are some areas less likely to use VA, even when there's many eligible veterans? I could say that in the Bay Area, it's not necessarily the San Francisco Bay Area specifically. There's veteran population, but it's just not, I would say, is up front. And in the past, there's been many bases that were in the Bay Area until about the early 90s. So we might want to think about the role of state and regional differences in terms of like high cost areas such as the Northeast and California. Also going into more detail about possibly looking at the role of lenders. So banks versus credit unions versus non-banks and fintechs. The non-banks and fintechs seem to be focusing more on VA and as well as FHA and so on. And their use of saying more VA eligible could mean, and it's focusing on an older population, as shown in the second paper. And that might be why one of the measures, I think, on the absolute share, the share of VA loans per 10,000, that seemed to be going in the opposite direction. So that might be an indication, even though like you see more loans when they're closer in general. So, and moving on to Jung and Sarah's paper, I think the biggest thing that would help in, and so I have more specific comments because this is work that's still in progress. So might be slightly more critical, but I want to be constructive, just not being upfront. Discussion, I think that we need to have a lot more discussion of the role of selection bias, both in terms of self-selection in individuals volunteering, as well as screening on physical and mental traits. And so there's a paper in Econometrica by Ankrist that goes into some discussion of this, and any research that looks at the all-volunteer force or after Vietnam will have to take this into account. I think it might be slightly less relevant with home ownership, but much more relevant with, say, income and household creation and so on. And so what I'm thinking about here is the self-selection, especially when you separate it into different racial and ethnic groups, what makes a white veteran different from a white non-veteran versus Black or Hispanic or Asian? I mean, there might be different career choices in front of them or not in front of them that might induce military service, as well as many other things. I mean, geography could play a role as well, the South versus the Northeast, and so on. But I think it's worth trying to delve into in more detail. I think into more technical comments, I don't, just the household as a level of observation, I think I just needed a little bit more exploration of some of the questions listed below, and maybe I need to learn a little bit more again of how the ACS is constructed, being like one person answering for the whole household. But could it matter which spouse is a veteran, or if both are, or how about the head of the household? It'd be interesting to know, like, if depending if the veteran spouse is male or female, does that actually change program use at all? Granted, the share of women in the military is growing, but it's still relatively considerably smaller than than male veterans. I was also curious, as a former reservist, how are reservists taken into account in the data? Reservists that did serve on active duty on campaign, though they'll be listed as a veteran when they come back. But there's also reservists that have just recently joined, that haven't been deployed yet, but can still take advantage of the VA benefit. I'd be curious to know, are they clustered among the veteran group, people that say that they're still on reserve duty, or clustered in the non-veteran group, or even if some of them might be still in active duty as well. Lastly, I'm not sure about the scale of this, but I'm be curious to know, what about how do you classify mixed race households? One, how common are they? Are they more common among veterans or less common? And curious to know how that classification is. I know it's more of a technical thing, but I like digging in the data, and I like to know how these things get set up. And I think lastly, with the household, no, with using the base regressions, did you have all sets of interactions in the measure? Specifically, does race by veteran status and base location also, like this three-way interaction, does it actually play a role in there? And maybe you run it, but there wasn't a significant effect, so perhaps you just used veteran alone once you got into the base locations. But maybe it's not going to be important with your final results, but I think some discussion of that might be useful, just to know how that's differential. Because you did that in the previous models. So moving forward, I'm going to show some research both from the Bureau as well as from one of the sources that Lauren mentioned. So a couple months back, myself with Jasper Clarksburg, RA at the CFPB, we had this short report using our consumer credit panel, the CCP, looking at first-time homebuyers and the relative home loan shares. In this slide, we're able to isolate first-time homebuyers by seeing who didn't have a mortgage in their credit history, and we have a match to determine veteran status in this database, or if they've ever served on active duty and so on. On the left panel is service members, and right panel is non-service members. On the vertical axis, we have the share of the market of each of those groups, with the mortgage origination date on the horizontal axis. And basically, it's the comparative shares of VA loans versus conventional and FHA/USDA that were used among both groups of first-time homebuyers. And we see that right after the financial crisis for service members, only about a third of these first-time homebuyers were using a VA loan. Most of them were using conventional loans before the housing crisis. Afterward, it shot up to about 2/3 and has continually been growing for this first-time homebuyer group since. And so that increase of VA loans mirrors the increase in FHA loans among non-service members, although that FHA bump for among these first-time homebuyers has declined in previous years to about little under 40% of non-service members who are first-time homebuyers. Another interesting thing, preparing for today's talk, from this paper by Fisher and Hugh on military veterans and neighborhood racial integration, which they showed that white veterans buy homes in slightly more minority neighborhoods, and black veterans buy homes in a greater sense less black neighborhoods. And so they're both white and black veterans choose homes that increase neighborhood integration. And this is one of the papers that I've seen that actually separate VA loans among black and white borrowers. And we see that the share of white and black veterans were relatively similar among the white population and the black population, and has dropped off over time to about 10% of each group. However, the VA program has always been a greater share of loans among Black borrowers than white borrowers. At the current time that they had their data, VA loans were only about slightly over 10% of white borrowers' total mortgages. I believe these are home buying mortgages, whereas among Black home buyers, it's closer to about 1 in every 4, about 25%. And so it's definitely an important aspect of borrowing among Black home buyers. The last few slides I'm going to go through are from our most recent HMDA report on 2019 using 2018 HMDA data using our new and revised data points. And this first slide is a histogram of credit scores by enhanced loan type. These are originated loans only. On the horizontal axis is the credit score with the index at 620 of a 620 credit score, and the vertical axis is the share of loans. And from the from what we see here, conventional loans, they're generally clustered among higher credit worthy borrowers, whereas with FHA and rural loans, those are more likely to be lower credit borrowers, but generally above 620. But usually around 620 to 700 is where much in their mass is. Interestingly, VA is relatively spread out between lower credit worthy and higher credit worthy borrowers. That it's not one's credit isn't a good indicator if you'll get a VA loan, as long as it's above 620. Although even some subprime borrowers are still able to qualify for VA, and this could be possibly due to other measures such as the residual income test and other ways that VA lenders determine creditworthiness compared to conventional FHA borrowers. This next one is either the most informative or least informative slide, which shows the histogram of VA loans with the combined loan to value. And pretty much when you get a VA loan, the model person gets it at 100%. So it's no down payment program. Most people will get it for the full loan amount. We see even some mass above 100%, possibly people using it to, borrowers using the program to cover the costs of the program, which range, as mentioned, from like 1.5 to 3.3%, depending on reserve, active duty, and is it your first time using the loan program, or is it using the subsequent times using the program? The last slide that I have on graphics here from the HMDA report is showing DTI on the horizontal axis, your debt servicing payments to income, and the vertical axis is the percentage share for VA loans with hash marks at 45 and 50 with small drop-offs. But you see that there's loans going up to 60% and even a small amount that go up to 70%, with it declining over time. By contrast, we have conforming in the top right side with small drop-offs at 43% and 43 DTI and then 45 DTI, and then past 50 DTI, you don't see conventional loans any further. FHA goes, those missing masses, the areas of mass that clump up are 45, 50, and then past 57, there's no origination. So I just presented all of these things in HMDA as possibly more opportunities for future research in terms of in the future, it'd be cool to see more research on some of this applicant and loan variation and how these perform in VA loans compared to other loan programs. All these possibilities of variation in terms of credit score. Not much variation in loan to value with VA, although it'd be, for not having that much, say, skin in the game, these loans generally perform well. More differences on DTI. And this, we don't talk about it. I mean, I think everyone knows who study VA does know a little bit about it, but it's, how do we research it compared to these other programs? But just the role of residual income with the VA origination compared to other programs. As other research has shown, what is this role of non-depository lenders in supplying VA and FHA home loans? They make up about 70% of these government-insured mortgages, and it's, just as much as the demand's important, the supply of these loans is important too. So lastly, I think it'd be useful to have some discussion of the history of when did this homeownership gap among veterans begin to close. We know about historical discrimination in FHA, and VA just used FHA's guidelines for a long time. And only since the late 60s, early 70s with the Fair Housing Act and ECOA, how did this happen pretty quickly, or was there some development over time with, in terms of legal changes, lenders, as well as the geography of lending to make VA a possible source of home ownership to shrink the housing gap? Thank you, and I look forward to your comments.
So thank you very much to our presenters. You've really unpackaged quite a bit for us, I think, to kind of discuss here. So as famous American scholar Matthew McConaughey would say, all right, let's dig in, shall we? So my first question is, what out of your presentation earlier and the research that you all did were you not able to touch on and that you feel would be worth raising here? Or if you felt like you touched on everything you needed to touch on, is there a particular nugget of research or information that you want to make sure the audience goes home with today? We'll just go down the line.
Yeah. So after looking at reading Lauren and also Patrick's work, one of the things that we did is only look at the 2017 ACS data, and if you look at their graphs, we did that both of them show that the VA mortgages, the share of the VA mortgages has risen significantly post-crisis. So one of the things that I think it will be interesting to further explore is that, so in our research, we show that the veteran status kind of like decreases the racial homeownership gap, but then was that decrease similar pre-crisis? And when we can kind of compare now and before, like maybe in 2000, when the credit market was less tight, and see if that down payment option is particularly more valuable because the credit becomes so much tighter, and also, especially for the racial minority population, there has a lot of the families became financially more difficult following the crisis. So without much wealth, this low down payment option might have been extremely more valuable. So looking at the time series, I think will be an interesting path to move on from here.
Well, thank you, Patrick, for the comments. I think that one interesting thing that you pointed out was about the uptake of the VA program by older homeowners. And certainly there's some really cool new opportunities now that the 2018 HMDA data now has age in the for the first year ever, right? We could capture that and see, because reports from the VA show that a surprising percentage of the borrowers who use the program are over the age of 55 or even 65. That was something that we learned relatively recently. And so I do wonder how that interacts with these service organizations and facilities that I agree completely. We would expect that more of the users of those facilities would be in the older demographics. I think that there's some really cool opportunities for additional work there. And also, since we're in DC and you all know where the data is hidden, I'm wondering to what extent there might be information in the VA guarantee limits, the historical limits. Currently, VA only has this data posted on their website going back to 2008. And in studying how those guarantee limits have changed over time, it seems that the VA has become a lot more aggressive about trying to price in these high-cost areas to accommodate veterans who need to buy in higher-cost areas. And I think that there could be some really neat work to look at how those policy changes over time, especially as compared to whatever was going on in the alternative markets, FHA and VA, FHA and conventional. If there's something else that we can tease out about opportunity there.
Patrick, Sarah, do you have any?
Can you repeat the question again?
I was just saying if there's basically anything that perhaps was left on the table that you feel is worth exploring, or if there's a golden nugget from your research that you want folks to take away from here.
Okay. I think, so one, I do agree with digging up the data and looking at the loan limits, because I remember when I was shopping for VA mortgage, now it's based, the loan, you can get, like if you live in a high cost area, you can get the same limit as getting like a Fannie Freddie loan now, but that wasn't always the case. And I know FHA changed differently than VA, and so like digging that up. I think in preparation of this talk, I was just thinking about like what happens on just in general, the real estate interaction side with sellers and loan officers, lenders, and so on. And probably even within the same lender, there's like, you'll have loan officers that know how to navigate VA and those that know how to navigate less. As well as it's been brought up to me before about, when a seller sees someone with a conventional loan and a buyer with an FHA loan and a buyer with a VA loan, how does that play into practice? And I mean, I'm curious could there be an audit study of that, or can we, like, how can we test that actual, that knowledge, or that, how does a VA loan or other types of loans actually happen, actually work out when you have to put into practice? And so I think there's some scope for that as well, like the role of the seller or agents or appraisals and so on.
Sarah, do you have any thoughts?
Yeah, I mean, I definitely agree that there's more that we left on the table in terms of using HMDA data. I'm a huge fan of the new variables, and I think that there's a lot more that we can do there. But another part of this that interests me, and I know that we're all kind of naturally inclined to talk about VA loans here just because of our backgrounds, but I think that an interesting thing to explore is the other benefits that may come with military service and veteran status and how that may play here. I know the current narrative is about student loan debt and medical debt and how all those things can be hindering housing, and I think we need to look more carefully at all of the other benefits besides VA loans and how those may be helping homeownership and income outcomes, and how maybe the VA loan plays a big role, but it's also that veterans are in a stable place in terms of their retirement savings, or they're in a more stable place in terms of healthcare. And I think that has really broad implications for how we can take these findings of how the military has been serving as an equalizer and apply them to other areas of work.
Yeah, I'd also be curious to know whether or not, from a state perspective and a state policy perspective in particular, if that may impact a veteran's choice in terms of where they pursue home ownership. So, for example, some states, I believe, exempt military pay. Some states have other policy positives, if you will, to influence where veterans ultimately settle. So I do wonder, too, where that may interplay or intersect here in terms of the conversation.
It sounds like you just set up a great natural experiment for us.
That's my job, right? So just to kind of unpackage a little bit on the knowledge side of things, Patrick, I wanted to touch on that a little bit. I mean, most of the data that we've seen here, although I think the exception was on VA refis most recently, but first-time home buying and purchase loans have been basically trending up for the most part. Is that a trend that may very well likely continue? Is it because, if it is it because the active service of our military, given that we're in an ongoing global war on terrorism and other conflicts that may come, could we see this trend continue? And if this trend does continue, what can we do to address some of these knowledge gaps? Because I believe, Lauren, your research indicated that there's a pretty healthy gap, at least, 30% or so, that veterans are not even aware of the benefit. What could we do? Any recommendations to improve that?
So just want to put out there, one, these are my own comments, and two, not the forecasting type.
Yeah.
But I think with the program, like I already mentioned earlier with like what's the role of lenders and agents and stuff. It's curious to know, like, without calling out anything, is like, are there certain lenders or certain agents that encourage or discourage VA lending still? And maybe there's a role for fintech in sort of equalizing that process, because like, a lot of the big VA lenders are some of the big online ones. They're just as willing to do that as other loan types, so it doesn't hinder what they do. In terms of like getting the knowledge out, I am surprised. I mean, that survey, and it was 2010, but still, like, knowing that it wasn't out there, because it seemed to be one of those things that even when I was serving as a reservist, like, you knew someone that got a mortgage and they navigate, like, you heard that they got a house and they got it through VA, and it was didn't sound very complicated at all at the time. So I knew that the program existed. I'm curious to know what the sources of that are. But I think that the program growth is, at least on the demand side, I think it's still going to be used. I don't know if in certain areas if there's other low or no down payment programs, but it also has the benefit of there's a funding fee that is waived if you have a disability. So that's a plus as well. But if the supply side were to be affected in any way, like, a lender doesn't have to do VA, doesn't have to do FHA. So what would happen if they step out of that, or for other reasons that may dry up? I think that would also be as important as, like, what people know on the demand side.
Lauren, did you have any thoughts to?
Yeah, so Patrick, about 2/3 or more of VA mortgages are currently originated by non-banks.
Okay.
Right? And so I think certainly we want to think about how does that change, and given that non-banks generally face significantly less regulation than their banking counterparts, what implications is that going to have for veteran and active service member borrowers? Something that we've been talking about a little bit. And also we were pulling up some of the data, more recent data, that I don't think any of our presentations were using, and finding that that overall VA mortgage lending between the fiscal year 2017 to 2018 declined, but the purchase mortgages were still up. Like, there's still growth in purchase mortgages, still growth in first-time home buyer purchases. These are according to the Veterans Administration puts out a very nice annual benefit summary. But the refinances were down. And we know that this is, you can't really talk about VA mortgages without talking about some of the recent things that have been going on to combat churning of veterans into refinances that maybe are not financially beneficial to the borrowers to justify that. That's something I don't think any of us touched on, but certainly it's something that we need to watch play out.
So before I turn it over to the audience, I'll have another question for you all, but I would remind our online audience that if you have any questions that you would like to have asked of the panel, you can submit those to events@urban.org. And again, I would encourage you to use the Twitter handles and make comments as well on social media using live@urban. My question next is sort of around kind of the role of an anchor institution. In this case, we talked about the military base as sort of an anchor institution. I was reading that the most recent, I believe it's the National Defense Authorization Act of fiscal year 2019, calls for the Pentagon to produce a report by February of next year as to whether or not a new BRAC process will occur. So a new round of perhaps base closures or realignment. So I'm curious as to kind of what you all think is the economic impact of having an anchor institution like a military base in communities. And as we think about, for example, like other large corporations and their corporate and social responsibility missions, you have Microsoft and other organizations that are thinking about their role as an anchor institution. I'm just curious what you all think about the impact of an anchor institution in communities, and if we have another alignment or closure process, what that may do to communities, and ultimately this playing field that we've discussed as an equalizer for people of color.
Can we start with Sarah? Because like we've been talking about this yesterday, and
Sure.
she's gonna start.
Sarah
Yeah.
seems eager to respond.
Well, I think this is a really important question, and I think this is the question that kind of moves the needle on what has happened with military and veteran homeownership versus what can happen to the wider homeownership gap. I mean, I know we use this talking point all the time, but 30 points is an enormous gap, and it's great that it's smaller for veterans and active military, but that's less than 8% of the total population. And yeah, I think there's no doubt that there is an anchor institution effect, just that when we look at these smaller towns and we see these smaller homeownership gaps, that there's something to say for stable employment. And it also, it's no coincidence that the military has a whole suite of benefits that they offer. So I think part of this future research is digging into all of these benefits and seeing what exactly can we apply to other situations. I mean, I know employer-assisted down payment assistance is starting to take hold in some other places, and there's some other examples of this that could be studied and compared to what we see with VA loan usage around military bases. That's probably a good place to start in terms of the homeownership angle. And just trying to apply some of these lessons that we learned from military bases to other employers around the country is going to be key in taking this to the next step.
Nice. Anybody else have any comments?
I'll just add on to that because when I saw, I think Patrick gave us a really important comment about selection bias, and I really kind of like, it let me think more about like, are there really differences between Blacks who choose to serve the militaries and Blacks who do not choose the military compared to whites who make similar decisions? Because like for Blacks, there's less employment opportunity outside of the military. And when I think about anchor institution, I still question whether a big corporate institution will play a similar role in a local economy like the military base. So I think we need to kind of look more closely into that and kind of think about what kind of particular thing that military base offers the local economy, to the local economy, that can be duplicated and also could be implemented in other firms, because I think a lot of for-profit firms obviously will not really take on the same strategy as military base because they have different purposes. So I think it's an important question, and I think it's a question that we will further investigate further. One of the things that I think one of the limitations that we have with this research is that one of the advantages that we have a large data set and we can like quantify some numbers, but we also need to go to communities and dig into like some factors that are real, like the real mechanism behind all these significant coefficients. So we are going to further explore the fundamental reason behind the racial home ownership gap across different communities. So from probably starting next year, we're going to select several cities and probably dig deeper into that. And then your question is one of the key questions that we'll explore further in the coming studies. So stay tuned.
Just so I'll use my sample size of myself example of just coming back to.
Seems like an important sample size
Yeah,
to me.
yeah, I was just trying to remember. Like, I do wish I knew more actually economically about what happened in San Francisco Bay Area during the '90s BRAC. But a lot of San Francisco Bay Area bases closed, such as and Northern California in general, such as my hometown in #Vallejo, with the Mare Island Naval Shipyard, which was a major employer and major source of opportunities in my hometown, and then that shut down in the '90s. And you know, as some of you may know, Vallejo had some ups and downs and declared bankruptcy during the financial crisis. And so that was an area after the base left, it seemed like they just kind of became dependent as a suburb of San Francisco, as a commuter place. And it was one of the areas where you'd see homeownership becoming more speculative than you would hope it would be. But then even other places in the Bay Area, or in Northern California, such as Alameda and Monterey, I'm pretty sure they had bases and airfields, and they somewhat adapted. They seem to be doing fine as a result. And I guess it's like a bigger picture of like, when a factory shuts down, how do you repurpose like the jobs in that area? I mean, for the most part, like at Monterey, they have a California State University campus. They have like other facilities. I know they're still repurposing stuff at Alameda, but I know like Mythbusters were shot there. They have a really good distillery, by the way. So,
Nice
but I
plug.
mean, and then it's probably closer to the Bay Area as a whole. So it's a nice across the Bay, next to Oakland, next to San Francisco. But I think that like the role of, like you said, anchoring institutions with VA, and maybe again less on the demand side with the knowledge that you can go online, you can go to a lender, you can always shop around. If borrowers shop around, like borrowers, we have evidence that borrowers don't shop around as much as they should.
Yeah.
But if in terms of like other factors with the base, like as far as information and or even like the lenders that exist, like if their base shuts down, affiliated businesses may also cut back contractors and financial institutions and so on.
Lauren, do you have anything to add? Or Lauren, do you have anything to add?
No, thanks for
Yeah.
those thoughts.
I would just say, of course, the BRAC process is always a messy process as is. It's very politically driven, and so it's just a report that is expected next February, but it would have implications over the next several years on several communities across the country if they decide to pursue that. I think we have time for an audience question, so I just wanted to see if there's anybody. Lori, do you have a question?
Thank you. Patrick, you'd mentioned residual income, sort of, which the VA uses in addition to DTI to determine eligibility. Have you guys done any work, or have you seen any work on sort of quantifying the benefit of using residual income on default rates or anything like that?
So I actually have not. I think I'm trying to remember if there's been maybe a presentation that even delved into that. Like we have research seminars that come to the Bureau, but I don't recall. I would love to see. I'd love to see some. As you probably know already, I've seen the tables in the CFR, and those numbers have not changed. They're not indexed for inflation at all, so they don't. Yeah. I don't think they would have as much bite right now, but.
The only variable you're missing is family size and calculating that ratio. That is, you have the income from HMDA. That is, you have the income from HMDA, and you could probably reverse the calculation if you had family size.
Oh, very interesting. Yeah, you can play with that or see what what is it in that jurisdiction and so on, and that'd be interesting. That'd be worth playing around with.
I love it when research ideas come up from data talks. It's fantastic. I think that's all the time that we have, and so I just wanted to thank our presenters today. Please join me in a round of applause in thanking our presenters. I will say the research for Patrick and Lauren should be available on our website, urban.org/events, and then the research that Jung and Sarah presented will be actually out in the next couple of weeks as a full report, so be looking for that. Thank you again for joining us.
Thank you.